With the COVID-19 outbreak, many of our real estate clients are certainly worried about their homes and we're looking for additional insights about their mortgage. So we brought in mortgage expert Kirk Eaton from the Kirk Eaton mortgage team. Welcome, Kirk.
Hi, Brian. Thanks for having me.
My pleasure. Thanks for meeting with us. Can you share your insights as a professional mortgage broker on how lenders are dealing with mortgage deferrals given the COVID-19 outbreak?
Yeah, the lenders and the big banks they're pretty much doing everything they can, I think, to help borrowers during obviously this unprecedented time. They've been pretty swamped since this whole mortgage deferral program came into play. Apparently, they've gotten about 500,000 requests in the first couple weeks that the program was available. So they're doing everything they can, but it's obviously something that they were not accounting for. And a typical lender, a major bank, will be offering a deferral program up to about 6 months. Some lenders are offering 2 months, but the typical period is between 2 and 6 months. But one really important thing to note is that it's not a mortgage forgiveness program. It's truly a deferral program. So the payment and the interest is basically going to be capitalized or added into the mortgage balance at the time period where it's going to end. And then in some cases, which I'm sure people have heard on the news, that some banks are going to be charging accrued interest on top of the interest that is going to be added back into the mortgage loan. So, you know, it can be expensive. So they're saying an average mortgage of about $300,000 with an amortization of about 25 years, maybe an average rate of about 3%. After all said and done, if they defer for about 6 months, their payments may go up by about $40 per month. One thing I can say is that, you know, if a borrower truly needs to defer their mortgage payment, then absolutely call your lender, call your bank and see what options are available. But if a borrower is truly just wanting to take advantage of not paying their mortgage, but they have the financial, you know, stability to do that, then don't call your lender, because they're just getting swamped with so many emails and calls, and they're having a hard time kind of keeping up with that. And it can take away from someone who truly needs it.
I really like the way you put it. Mortgage deferral is not mortgage forgiveness. And I think that gets confused by a lot of people.
Yeah.
How does the everyday consumer understand what the cost of the mortgage deferral will be to them, Kirk?
Yeah, so the lender should, when they apply for the mortgage deferral program, the lender or bank should be providing some cost of, like a disclosure, cost of borrowing disclosure to that lender or to that borrower, basically breaking down what it's going to cost them at the end. So basically, like I said, the interest that won't be, or the payment and the interest that won't be paid for that time period will be capitalized back into the mortgage, and then they will start paying that back at the end of the time period. So right now, like I said, most of the lenders are offering up to 6 months. Some are offering 2, and looking at it on a 2-month basis type of thing. But the lenders have been doing a pretty good job of trying to keep up with this, I think. But of course, I don't see really what's happening behind the scenes in terms of, you know, the calls and the emails to lenders. But I heard a few weeks back that the very first day that this program came out, one major bank in the first 24 hours got something like 38,000 emails for mortgage deferral payment relief. So it's been a lot. But yeah, I know they're doing a pretty good job trying to keep up and trying to accommodate every borrower they can.
So the right way to look at your mortgage deferral is really a lifeboat.
Yeah, basically, it's just, and a lot of lenders. I mean, some banks and some smaller lenders like MCAP have actually some built-in privileges, like they're called skip a payment. So like even before this whole payment relief program, you were actually able to call your lender and skip a payment. So yeah, it's a lifeboat. I mean, it's there to help out the borrower in times of need, only to be, you know, temporary. But if you truly don't need it, and you can, you know, pay your mortgage on time, I would obviously recommend keep paying your mortgage as is, because you're paying down principal. You're going to be paying less interest over time, and you're just not going to be, you know, wasting the lender's time where that, you know, they need to allocate their resources accordingly for borrowers who actually, you know, need that financial assistance.
Great advice. In terms of if I've lost my job or I've recently been laid off, am I still able to refinance my property?
Yeah, good question. If you've been, I'll back up a little bit. So if you've bought a property and we're working on a purchase transaction, and you've been temporarily laid off or laid off in general, and you've been issued a commitment prior to this pandemic, lenders are doing everything they can to work with borrowers and honor that commitment. Purchases will always take precedence over a refinance. For a refinance, if you've been temporarily laid off or laid off in general, refinancing right now is very difficult. Lenders are typically not issuing commitments, not approving those files. However, if it's temporary, and I'm doing this for a few clients where we're actually able to still get them an approval on a refinance subject to the condition of them returning to work full time.
Okay.
So I have a client right now who they were laid off temporarily, just returned to work yesterday, and we're going to be looking at closing that refinance in the next few weeks. However, the lender needs a recent pay stub proving that they've gone back to work and earning that income before instructing the file and closing that refinance application. If someone truly needs money and they can't refinance traditionally with their bank or a lender, there are other options available like alternative lending and private lending, although they are more expensive, where some of those lenders will look at more of, loan to value, equity in the property over income, things of that nature. Debt service ratios are higher than your traditional banks and A lenders. So we can look at doing it that way. However, it can be more expensive. But if it's hopefully just temporary, and someone truly needs to refinance to pay bills or pay their mortgage, then yeah, there still are options available.
Kirk, thanks for your time and your great insights. We really appreciate it.
No problem.